Obamacare increases by 20% next year. 20%, says the Wall Street Journal. Some enrollees could be hit with increases of more than 20% because of federal changes in higher health expenses. Okay, so that's, we don't know. But I want to dive into something here because my thoughts are, what if it does make sense to do some Roth conversions while you're still working to avoid those higher Obamacare expense when you retire? So what we're going to do, we're going to dive into Right Capital here. And what I've got going on is I got Diane Sample, and we're going to say she is 45 years old, all right? And she's making $100,000 a year. Where's her salary? Right there. No, $100,000 a year is right there, salary. And she's going to retire when she's 55, all right? So she's going to work another 10 years at $100,000 a year. And what we're going to do, now, I'm going to show you right now because she's single. She is in a, right there, marginal tax bracket of 22%, all right? All the other stuff in terms of retirement probability, none of that matters here. We're just talking about taxes and healthcare cost. Because my thought process is, what if we started doing some Roth conversions and Roth contributions to our 401k, even though it's going to pay a 22% marginal tax rate, so we can avoid some of these significant healthcare costs. And I think this gets overlooked by almost everybody. I really do, because everyone just looks at the tax brackets. And I was thinking about this when I was reading this article. All right, so what we're going to do here, we're going to bring that up a little bit. There we go. All right, so what we're going to do is we're going to have Diane Sample, and she's going to put into her IRA or her 401k savings. She's going to have 6% match in her 401k, but it's all going to the Roth. So she's going to contribute to her 401k, Roth 401k, and she's going to have her employer match go to the Roth as well. All right, so what's going to happen here is we're going to have her having $12,000 a year essentially going into the Roth. I'll show you what I'm talking about. So you can see plan savings, that's her $6,000, but then you'll see additions to accounts. You'll see the Roth is getting $12,000, her $6,000 plus the employer $6,000. All right, so by the time that happens, her Roth will be right there. By the time she retires, her Roth 401k will be about $163,000 because she's retiring at 2035. All right, so her expenses, we're going to have her expending, her goals at retirement are going to be $4,000 a month plus healthcare, $4,000 a month plus healthcare. All right. I hope you're tracking with me so far. So when she retires, she's going to spend $4,000 a month plus healthcare costs. And so what we're going to do, we can come back here, and I'm telling the software, I'm saying, hey, look, software, we want to cover those expenses. Here's her salary right here while she's still working. Here's her taxes, all that. We want to cover those expenses by, this is retirement expenses. Again, the $4,000 a month today, we're inflating that 3% a year. You can see right there, $4,000 a month today, inflating at 3% a year is almost $5,000 a month in the future. All right, so we're going to take $80,000 a year from our accounts. We're going to take $50,000 from our Roth and $30,000 from our pre-tax 401k because she has $1 million in pre-tax 401ks. So again, what we're doing is we're just saying stop the pre-tax contribution. Let's try to get the Roth as built up as much as possible. All right, and so she's going to be taking $80,000 a year out, $50,000 from a Roth, $30,000 from a traditional in order to qualify for Obamacare. Remember, you have to have some taxable income to qualify for Obamacare. So you can see her taxes are very, very low. All right, in fact, you can see if we go to the 1040 right here, details of 2035, right there, she only has $30,000 that's actually even flowing back to her 1040 because the Roth that she's taking out is not doing that. And so you see she only pays $984 in tax. So what does that mean? That means she's going to qualify for significant Obamacare premium credits because she will be below 4 times the poverty level, assuming everything stays in flux, which I think it will, stays the way it is today. All right, so I hope that makes sense. So basically what we're doing here is we're going to say how much is her Obamacare going to cost once she is on healthcare. All right, well, I think it's going to cost her about $200 a month because she'll get the premium tax credits. Unfortunately, she'll run out of the Roth when she's 2040 and when she's 60 in 2040. So she's going to go back to paying Obamacare premiums. And I have her paying $1,000 a month today in today's dollars, which would be the equivalent of $2,000, about $100 a month in the future at 5.5% rate. All right, so her Obamacare, full Obamacare premium is $1,000 a month today because she's single and she's above 4 times federal poverty level. And so we're having her pay $1,000 a month, adjusted at 5.5% inflation, which is $26,000 a year in 2040. So the Roth does her great for these 5 years, but then she's still got 5 years on Obamacare, and she's going to get walloped. All right. So what we do is we're going to come over here to go to retirement, go to analysis, and we're going to see exactly how much her income tax was. All right, and we're going to go over your retirement details. We're going to say her income tax is, spending comparisons right here, $74,000 in total. I think that's just federal income tax. I can't remember, but it's $74,000 of tax plus her total healthcare costs will be $112,000. All right, everybody with me on that so far? That makes sense. So again, she has $1 million in her pre-tax IRA 401k. She's no longer contributing pre-tax. She's now just contributing post-tax to her Roth, meaning she's going to pay a higher bracket on that today because she's in a 22% marginal tax bracket. But she's doing that to sacrifice the money today so she can afford, in this case, 5 years of very, very cheap Obamacare premiums. All right, so now what we're going to do is we're going to compare that to basically putting all in deferred, So let me take a break here for a second. So now what we're going to do is we're going to have Eric contribute everything into, no more Roth. We're pretending the Roth doesn't exist. We're saying, okay, she's going to keep doing what she was doing, which is contributing everything to her pre-tax account. All right, her pre-tax 401k. So you can see she's got $12,000 going into her 401k, $6,000 from her, $6,000 from her employer. You can see her taxes here. She's still going to be in the 22% bracket. Right there, 22%. All right, so she doesn't save. She's literally saving 22% on $6,000. That's a fact. In fact, in this case, because she's not doing the Roth contribution, or her employer contribution is not going to the Roth, she's saving 22% on $12,000. So we know for a fact she's saving 12,000 times 22%. She's saving $2,640 a year in taxes because she's doing the pre-tax contributions. All right. But the problem is what's going to hit later. All right, so you can see once she retires, and we're doing penalty-free distributions from her 401k because of 55-year rule right here. So we're basically taking $100,000 from her 401k. It's all going to come out. And that's going to cover her expenses right here and taxes. So you can see it just barely covers it. Not quite, but pretty doggone close. It covers her expenses and taxes. So her expenses, again, $4,000 a month, living expense, adjusted for a 3% inflation. So that's going to be about $5,500 a month in 10 years or so, plus her health care. But again, her health care was $1,000 a month today for Obamacare because she won't be she'll be above 4 times the poverty level. And it'll be $20,000 a year then. So her expenses are going to be $85,000. Well, she needs all that to come from her 401k, so she's going to have a big fat tax expense too, as you can see here. All right, so her tax expense is going to be another $15,000. So basically, and we can actually go to 1040 here, and we can see that by and large, she's going to get the penalty free. I still got it. Well, actually, penalty free there. Did I get all her penalty free? I think I might have. That's good if I did. Yeah, all right, sweet. So it's all penalty free. So these are the actually that's her work. Hold on a second. Yeah, right there, 2,000. Yeah. So we take 450 off there because I didn't actually take the time to do everything penalty free. 27, so that's basically 450. It's $1,500. 2038 0. Okay, good. So basically 2039. Yeah. So $1,500 would be reduced from what's actually going to show up here because she's not going to have to pay a penalty because she's the post 55 rule. But watch the difference in healthcare cost and watch the difference in taxes as well. Go right here. Spending comparisons. Here, her total taxes are $134, which is almost double what she would have paid the other way. Here, her total taxes are $180. Our total healthcare costs are $180. That's crazy, man. And I need to clear up. I didn't say this at the beginning. We only have her live until 65 just for giggles because I want to keep it until she's on Medicare, if that makes sense, and then she's dead. So I just want to do a comparison. So if she did the Roth contributions, all right, at 6% clip plus her employer's contributions at 6% clip, all in stocks, by the way, and the stocks give us a let's see, stocks. Oops, hold on a second. Give us a U.S. money market. a 7.2% effective rate of return, effective a 7.2% rate of return. If she did, it's $12,000 a year for the next 10 years, that gives us a pretty significant amount of money in there, in her Roth for sure, because we have her working. She's 45. She's going to work till 55. So $12,000 a year. We could take our trusted calculator. Gives us $167,000, assuming she gets a 7.2% rate of return. All right, and that's in her Roth. That's just with her putting her money in plus her employer's in there in the Roth, which is what we did the beginning scenario. This scenario right here, we're not even doing the Roth. We're just saying, no, we're going to keep the tax. We're going to save the tax on 22%. That's not a good strategy, man. All right, so then I want to take another strategy. What if we just did some conversions as well as doing the Roth contribution? So let's check this out. In this case, what we're going to do is we're not doing anything else to pre-tax stuff. We're doing everything into a Roth. So her 6% match and her 6% contribution are going solely into her Roth, which means she's going to have to pay an extra $2,600 in taxes, 22% tax bracket. On top of that, we're going to convert $35,000 a year, all right, to build up that Roth. But we're only going to do it for 5 years. We're going to do it for years today, years 2025, all the way through 2030. We're going to do it for 5 years. I think 5 years, something like that. 5 or 6, it doesn't matter. And so what the point will be is we're going to actually take from her IRA. We're going to essentially what happens once she retires in 2035, she's going to pull $50,000 a year from her Roth 401k. All right, now we're not converting into the Roth 401k. The software didn't allow that, so we're going to convert into a Roth IRA. All right, so she's pulling $50,000 a year from her Roth 401k, and then she's going to supplement that with $30,000 a year from her pre-tax 401k. Both will be penalty-free because of 55-year-old rule. All right, and on top of that, she'll qualify for significant Obamacare premium credits, assuming that the law stays as it is. Once she's 60, her Roth 401k will be exhausted, but her Roth IRA will be there. You see what I'm saying? Because the Roth IRA, she was converting $35,000 a year in the year 2025, 2026, 27, whatnot. So by the time she's 60 years old, that Roth IRA will kick in because she's still on Obamacare, and it's all penalty-free and tax-free because she's had it open 5 years and over the age of 60 or 59 and a half. And then she'll still qualify for the Obamacare. All right, so now let's check this out. Watch this. All right, so now, by the time she hits 60 years old, her Roth IRA, again, we're taking money from the 401k until she's 55. And once she's 55, we're going to pull money out. We're pulling money out at a $50,000 a year clip, all right, to cover until she's 59 and a half, all right? Then she'll just pull from her Roth IRA. Now, obviously, this won't be exact, but you get what I'm saying. But the 35,000 she converted, all right? So we go to net cash flow. She's converting 35, 35, 35, 35, 35, 35. By the time that 35,000, by the time she hits 60 years old, where she needs to start pulling from it, that 35,000 is going to be worth 317,000 essentially. And so now she's going to pull. How much did I have her pulling from? Withdraw, I think $80,000, something like that. 50,000 a year. Yeah, 50,000 a year from her Roth 401k, 50,000 a year from her IRA, Roth IRA, to complement the 30,000 a year she's pulling from her pre-tax account, so she can continue to qualify for Obamacare. Hope that makes sense. So you see what I'm saying? So now she's like, all right, I have 2 pots of Roth money, the Roth 401k, which will be penalty free because I'm over the age of 55. And then my Roth IRA, which will be penalty free because I'll be over the age of 59 and a half, and it's been open for 5 years. And because I did it initially right now, it got to grow even better. Hello. Anyway, this is a great strategy. It's something I didn't think about. But so what happened? And we're still pulling $30,000 a year from our pre-tax to make sure we qualify for Obamacare. I cannot stress this enough. Right? You still got to do that, and just watch her taxes. Hardly anything, because she's pulling it all from a Roth, other than the $30,000 she's pulling from her pre-tax accounts. So watch what happens here, dude. This is crazy. You're never going to see any analysts like this other than what I'm doing, I'm telling you. So make sure you subscribe, hit that like button, and send me a super chat or buy me a cup of coffee down there. No one's going to talk about this like I do because your old buddy Josh gets it. All right, so now her taxes are $10,000. What? Look at that. And her healthcare is $34,000. What? $10,000, $34,000 once she's retired. Now, she's going to pay more taxes today. Don't get me wrong. I mean, look at that. Her taxes right there, $37,000. But again, as I talked about before, if we take 22% tax bracket, we already talked about that $12,000 going to the Roth. That's only $2,600 a year. 35 times 22.22, that's $7,700 a year. So I mean, so she's paying an extra $10,000 in taxes a year for the next 10 years to save. I mean, how much is she going to save? She's going to save. Let's go back here. Oh, we got to go to here. Because I didn't even write it. Should have written it down. She's going to say in retirement, she's going to save. Right there, boink. She's going to save 10,000, 125,000 in taxes in retirement, plus 146,000 in healthcare costs. She's going to save. I mean that's 146. What did I say? So we got 134 minus 10. That's 124 plus 180 minus 34. I mean, that's freaking 100 plus 120. She's going to save like $271,000 if she does this strategy. Recognizing she has to pay an extra 100,000 in tax, so she'll save $171,000 in taxes just by doing this Obamacare strategy. Crazy. Never mind all the other stuff that might come in, to lower tax on Social Security, the whole thing as well. That's how you deal with the massive increase in Obamacare, is just prepare for the future inevitability, which is that Obamacare is not going to be any cheaper anytime soon, and you better be able to have a way to deal with Obamacare before you hit 65 on Medicare. And this is the way to do it, for sure. All right, love to your thoughts. Smash that like button. We'll see you.